Chisholm. Kirk, you guys might know him from about an episode we did about a month and a half ago. He is a founding principal and partner at Innovative Wealth, which is Innovative Advisory Group. I should know that because I also work there too, but I was trying to look at other screens. One of those other screens was going to be Jim Cramer, and Jim Cramer is so excited about what's going on with the Federal Reserve. So what we're going to do is we're going to kick it off with him and then get some commentary from the guys on exactly what's going on with the Federal Reserve. So here we go.
Say, hold out, it's coming. It's coming. It really is. Hold, as I'm sure Joe knows exactly what I'm talking about. I say hold. You got to stay in business because if you
Okay, so Jim Cramer right now, he says it's coming. You know, so it's coming soon. But what's coming soon? Here we go.
The Fed is just the Fed is on its game. And this is what is needed because we got to fight off a depression. We got to get America open for
Okay, we got to get America open for business, John. The Fed is coming. It's coming. It's coming. But what do you think of what the Federal Reserve is doing, and what do you think is coming, John?
Well, right now they're bringing in the helicopters, right? And I guess the cavalry to the helicopters is the bombers, you know, that are coming into the final.
No, they said that. They actually said, I forgot who it was. I don't know if it was Mnuchin or one of the stooges in there said, no, we need to have the B-52 bombers coming. So it's actually so the helicopter money isn't enough. You know, our little made in China, Trump, keep America great again, money guns, that's not enough. And the other one I got for my daughter because she had to have one too. Both of those dual wielding and John's, that's not enough. We got to have the B-52 bombers. Sorry about that, John. Oh, there he goes. Oh.
Yeah, you're running out of cash. They, you know, to just quote Ben Bernanke back in his 2002 speech, actually Ben Bernanke said that, you know, the power of the printing presses will always win over deflation. That's his point of view, anyways. Doesn't necessarily have to be our point of view, but that's what they want, anyways. They can't have deflation because with deflation that kills, you know, their whole Ponzi scheme that they're running with the constant need for more debt to pay off the ever increasing interest on that debt on a global basis when you look at the big scheme of things. But, you know, coming back to exactly what we're going to talk about here and what's coming, and there's so many programs out there. You know, I have such a hard time trying to wrap my head around all of these programs. You have the repo program going on. You have, of course, the quantitative easing that they're buying, you know, agency mortgage-backed securities, and they're buying treasury securities, T-bills, all this kind of stuff. And that's not enough. So they, you know, added facilities where they're actually sending out $1,200 to a lot of American citizens. Then, of course, they have, you know, relief programs.
And in some places, even not American citizens, if you're in, was it Chicago or probably places in California where it does, you're not a U.S. citizen, doesn't matter. Can you breathe? Can you vote for Joe Biden? Even if Joe Biden's just like weekend at Bernie's and they've got to trot him out there, or Andrew Cuomo, who I think is probably actually going to be. But anyway, sorry about that.
No, they definitely have, you know, the places to run there. But then they, of course, are doing so many other corporate facilities now, because actually now they're looking at buying ETFs and other eligible assets. And as you can see, Tim, if you want to pull up, this is just the one that's, what is their program here? It's called the PMCCF. So it's basically the primary market corporate credit facility. And there's also one called the secondary market corporate credit facility. Both of them are in tandem. They're both the same programs, just different markets. So here they're actually looking at, you know, the eligible corporate bonds as sole investor that they're going to be looking at buying is the facility may purchase eligible corporate bonds as the sole investor in a bond issuance. Eligible corporate bonds must meet each of the following criteria at the time of the bond purchase by the facility. So it says issued by an eligible issuer, and the maturity has to be of less than 4 years. And then, of course, they're looking at, you know, eligible syndicated loans and bond purchase.
Well, my favorite part. Yeah, my favorite part's at the very end when it says. The facility will cease purchasing eligible assets no later than September 30th, 2020, unless the facility is extended by the governor of the board of directors of the Federal Reserve System and the Treasury Department. So unless, I mean, just like when we said that in September 17th. like at September 17th when all the repo stuff started going down. It's like, oh, we're just going to start with, I forgot what it was, like $40 billion a month.
Yeah.
And we're going to end this in like the second week of October. Then it was like, oh, it's going to be 45 billion. And it's going to end a week or two after that.
Yeah.
Oh, then it's going to be 50 billion. Oh, it's going to be 70 billion. Oh, it's actually going to be $100 billion a day. Oh, actually, we're going to give you up to $1 trillion repo day if you need it. Oh, by the way, now you don't have to hold anything in reserves anymore, which I don't know, Kirk, if you were aware of that during the press conference with Powell, he actually said that banks don't even have to hold anything in reserves anymore. And there's actually him saying
Welcome
that.
to Canada. Welcome to Canada. That's what we have, our zero reserve policy. It's called by the PhDs.
Yeah, the U.S. I mean, with the way things are going now, I mean, we had the CARES Act that just passed just last week. They had part of that. They said that the PPP loans that the banks were giving out, which by the way is a boondoggle for the banks, which I'll get into in a moment. They said that has to come from their reserves, and they can spend it. And a lot of banks are lending out all of the reserves that they have. So they're just like, sorry, we can't give out any more money. One of the things in the CARES Act, which I find interesting, is it was a great idea. I think it was probably the best way I've seen for the government to actually give money to small businesses, because usually they just ignore small businesses like they're just an annoyance, just as a way to support the big businesses. And of course, that's not really competitive, but that seems to be the way that they went. And they said, great, here's all this money for small business owners. And then they said, all right, here's what it's going to be. You're going to be able to pay 2 months of wages, and we're going to basically give you free money. So you could get a loan from the bank for 2.5 times your monthly average wages. And then once you get that money, then you get to basically deduct, quote unquote, deduct it against your actual wages that you spent.
Assuming you aren't bankrupt by the time you end up getting the money, I guess.
Agreed. So there's a whole bunch of problems with that. But let's just assume for the moment that you're actually paying people, because that's the whole point. They say if you lay people off, then you don't get it. So you get, if you actually pay people, then they forgive the loan. So they're basically giving you free money through the banks. What's interesting is they gave the banks 5% for 0 to 350,000 of a loan. They're giving the banks 5% off of that. I mean, the banks are going to make a killing. Now, what was interesting was they also put in the law, they said that, agents get 1% of that. And agents being like accountants, attorneys, people who are kind of like helping fill the application. And what the banks did, which was really terrible, what the bank says, yeah, but we're not going to take applications if there's an agent on it. So they didn't say that they wouldn't pay agents. They're just not going to accept applications that have an agent on it. You want to talk about a big lawsuit waiting to happen. And unfortunately, the AICPA didn't even bother backing their own CPAs. All the CPAs I know were furious. They're really mad because they're like, well, you shouldn't be charging your clients anyway. Anyway, I don't want to get down a rabbit hole, but the point is that, the banks are taking full advantage of this. They're going to make a lot of money with this, and business owners, maybe they'll get their money. I mean, the banks are, the big problem is, let's assume everybody's going out for the best interest of everybody else. You have every single business owner in the country applying for this loan in like 2 days. There are not enough bankers, not to say that there should be any more, but there are not enough bankers out there to process all these loans. There's just no way they're going to be able to do it. And then you have the other part, that's the 7A36, the PPP as people call it, the basically the principal protection
paycheck.
Paycheck protection. And then you have the other one, which is the 7B, which is the disaster recovery loan, which everyone knows about because the way advertisement was, hey, you apply for this online, you get $10,000, and they give it to you in 3 days. And everybody signed up. Now nobody's.
If you're not sure if you need it, just apply anyway. That was the other.
Just apply
on the government's website. Literally, that's what it said. Yeah.
There's more. No, this is good. So they say just apply, and there aren't a lot of parameters. It just says just apply, and you can get up to $10,000. Well, they don't really tell you at the beginning how they're going to characterize it. They said up to 10,000. Well, everybody just assumes they're going to get 10,000, right? Well, there was no criteria behind it. So what happened was, apparently, because the SBA is actually funding this. So the SBA put out, at least in my state, they said it's $1,000 per employee. And the way it works is you get that money supposedly within 3 days, and you get that money directly into your bank account. And if you apply and you don't qualify or they reject you, you get to keep the money. So it ends up being a grant. And that's why everybody found it so appealing. Now, if you apply and you want it, you can get up to $200,000 without a personal guarantee at 3.75% for up to 30 years. So it's actually reasonably attractive. The problem is last week we had a few people contact the SBA. They said, we don't even know when we're going to start looking at applications. They're sitting there and it's not 3 days. They further characterized that and they said, it's 3 days from when they look at the application that they're going to send you the money.
I thought maybe the Easter Bunny. I thought the Easter Bunny was going to bring it, and I've already lost hope on that. So,
yeah, I'd say my kids are hopeful for that too. So if you look at what's being done in theory, the government actually, and I don't really say too many good things about the government, but in theory, what they did was reasonably effective for what was needed. And, you throw it into practical purposes, the SBA is not equipped to deal with this. The banks aren't equipped to deal with this. So if you look at what's actually happening, businesses, it might be months before businesses actually get the money that they need. And by then, we're still going to be in lockdown, at least for my state. They're saying until early May. And by probably next week, it'll probably be, they're already talking about canceling summer camps, which means possibly the fall. So what are businesses going to do after that? I mean, there's a lot of questions that are coming to mind here.
What are your kids going to do on Cape Cod? And actually, so Kirk is coming to us. He's usually from Boston, today in Cape Cod, because he had to escape all the craziness of the city. And so he was able to get his family out of there and escape some of that craziness. So just want to say that he is in a pretty communist state over there. So then we got sorry to our Massachusetts.
Liberal, Tim. Don't confuse the two. I know it's really close.
It's Democratic social. But anyways, now, what's going on with Trump and everything else? Basically everything I feared that Bernie Sanders is going to do is everything that basically is going on now. But Kirk is probably one of the most knowledgeable guys I've heard talk about, or actually has the most knowledge of any I've heard talk about the CARES Act and everything that's going down. So sorry for interrupting you, but actually, let's go to an article on screen. We did play this the other day, but this was from the CEO of, I can't pronounce the guy's name, from Social Capital, Shamath Palihapitiya. I don't know how to say that, and just absolutely butchered that. Anyways, he goes on to say that, listen, that these bailouts are basically going to helping guys, with yachts and hedge funds guys and PE guys who, should be supposedly the most sophisticated investors in the world. And yet, how come all these, hedge funds whose job is to hedge, and then they're not even, and then they're the ones who are getting access to all this money and going on with, all these companies like the airlines who spent something like $46 billion on stock buybacks, and yet they're now going to get a bailout of $50 billion. What do you think should be done from especially from a free market perspective? Do you think that these banks should have just sold, that these big corporations should just be forced to sell stock to, recapitalize themselves? Because they made all the money on the way up and we're buying back stock and issuing debt. I think that the bondholders should be getting a haircut, that if you were dumb enough and greedy enough to get into bonds at a certain point, then you should have to deal with your losses or have haircuts on the bonds to recapitalize, and we should have some actual capitalism going on. I'm calling this Corona capitalism, to make a bad dad joke about the coronavirus, but sorry about that, Kirk.
No. You make some great points, Tim, and I think if you think about what's kind of happened, in theory, this system was, should have been done reasonably well, but in practice, it's not. There's no way you can just put the entire country into a disaster mode and decide to give everybody money. And I think, I don't agree with printing money and giving it to people, but if you're going to force people to not work, then, I would say that you kind of have to compensate them. I'm a free market capitalist through and through, but at the end of the day, if you have to do that, then you gotta compensate businesses.
We're just getting our stolen money back anyways. So
right.
That's sort of how I view it.
Yeah, no, exactly. But when you look at the big businesses, they'll be fine. Here's some good examples. And you started talking earlier about the Fed buying corporate bonds. This week the Fed decided, hey, we're gonna buy junk bonds now. So they can buy junk bonds. So if you look at, here's a good example. So you look at the junk bond market, or if you look at actually the AAA market is now 53% of the corporate bond market that is investment grade is now triple B. So it's on the edge of being.
And it was already 50% even before the crisis. So my talk that I gave at Acapulco, one of the main, I had a section entitled Black Swans, and it was, I don't know what black swan is going to kick it off. And this was at February 11th, and I was still discounting all the coronavirus stuff and didn't even mention it once in the talk. So I guess I missed that part. But what I was saying is that you had at the time before things went bad, you had half the investment grade bond was at triple B, and then that triple B's getting downgraded to double B will then force these funds to have to sell from their index funds that are mandated to only have investment grade bonds and up, and then that selling would then beget more selling, which would then beget more selling and create an avalanche, which then would be great for our put option strategy, but where we could buy more coming in, but it's like at the end of the day, it's like the people that were trying to be responsible are the ones who keep getting screwed. The savers who, were keeping money in cash, I mean, they still get screwed in terms of now, the fact that anybody thought we could ever have real interest rates to begin with is sort of beyond me. When I was with Dell & Reed, they actually chastised me for saying in an email in 2011 when I told somebody that I thought the Fed could never effectively raise rates because as soon as they did, they'd pop a bubble in the bond market and then they'd have to go back on that.
Well, actually, when you look at the PMCCF and the SMCCF, actually the SMCCF is where you're talking about the ETF eligibility here. And what's interesting here, we're talking about the Fed is buying it. It's actually they're leveraging the what is it called, the Exchange Stabilization Fund here. So it's basically the U.S. taxpayer. So it's a shadow TARP fund where they basically are doing up to $750 billion in each fund. And they so that's $1.5 trillion of taxpayer money that's going to be owed somehow. Who knows what? But what they're buying is they're buying any, like on the ETF side, the facility also may purchase U.S. listed ETFs whose investment objective is to provide broad exposure to the market for U.S. corporate bonds. The preponderance of ETF holdings will be of the ETF whose primary investment objective is exposure to U.S. investment-grade corporate bonds, and the remainder will be in ETFs whose primary investment objective is exposure to high-yield corporate bonds. And as they said further down in this article, when you go and look at the details, there are actually an issuer that was rated triple B minus as of March 22nd, 2020, but was subsequently downgraded, must be rated at least double B minus as of the date of the facility makes the purchase, or else they're not eligible for this. But that's where we're talking about the junk bonds. That's right there, right in writing for everybody to see.
Yeah, and Kirk, we'll kick it off to you because as part of that CEO of Social Capital, what they were talking about is, listen, like if you don't, because what everyone is saying is, oh, well, if we didn't come in and bail out all the companies and all the airlines are just going to go away and no one's going to be able to fly anymore, and they're just pulling on like Americans' heartstrings, which in reality what would happen is those bonds would then, it would probably maybe become worthless or they'd be restructured. Somebody else would come in and then those airlines would still fly. So, I mean, can you maybe talk a little about what goes on when companies would have to restructure debt versus the what they've taken? I mean, it is a comment of one of the 10 tenets of communism is having a central bank. And I mean, we've said this before, but I mean, John and I pay attention to this stuff. You pay attention to this stuff every day, and it's even hard for us to even keep up with the pace and the scope and the craziness of what's going on. So, I mean, break it down for us, Kirk. What's going on?
Yeah, let's look at a few different examples here. So, as of 2 weeks ago, one of the automakers was downgraded to junk. And interestingly enough, in 2008, a different automaker was basically bankrupt, and they were bailed out. So
and they took their bailout money to move their operations overseas. So great.
Right. Yeah. And I can't say the names. I'm sure you can find them just for regulatory purposes. But let's just say for that example, what the government did was they bailed out the company, and they basically hosed the bond the holders of the bonds in favor of the unions and the company. And in my opinion, I think they gave like 70% of the remainder to the unions. And I said, why don't you just give 100%? Let them run it and see what happens, right? If you want to really see if this is going to work, to give it all to them and see if they run it to the ground or if they make it work. And that's a good case study. But I think that's an example of probably what not to do. I mean, they totally shredded contract law, and it was just a mess. And I understand why they did it, but still they set a bad precedent. But if you look at the way things should work and the way that, I mean, the whole industry is built around this. So if you look at an example like Toys R Us, right? And that's, I don't think they're not public anymore, so it doesn't really matter. So I can use them as an example. So you look at like a few months ago, I think it was maybe 6 months ago, they went bankrupt. And they didn't just get restructured, they liquidated. Because what happened was, I love Toys R Us. My kids used to go there. I don't know how they stayed in business. There was no one ever in the store. But eventually, I think the bonds were trading at a premium, believe it or not, a premium, until the day they decided to file for bankruptcy, which case they went down like a huge amount overnight. And the problem is the corporate bond market is not being priced properly because people are looking for income and they're willing to pay whatever to get it. A lot of these bonds are put into funds. They're put into ETFs, which means that they're not getting a real price. They're not getting priced where they should be priced. They're just priced because someone wants to buy it and put it into a fund. So they're not getting actual real market valuations. So what typically happens is if a company like Toys R Us, for example, they file for bankruptcy, what'll happen is these people will come in and they'll start looking at the assets and they'll say, all right, what is this worth? And they're liquidating. So they liquidated the stores, they liquidated the goods, like all of the assets of the store. And then eventually there's no more assets and then the company's gone. So if you manage your company poorly and it decides to effectively, you run it so poorly that you have to liquidate the company, then that is the natural result of poor management. Now, there are different types of, when a bond defaults, they're restructuring. I mean, if you look at certain real estate, there's certain real estate moguls who do this all the time. I won't mention any names, but certain real estate moguls will constantly restructure because they can. So it's just a way to reduce the amount of debt on the balance sheet. Now, the system is set up to deal with that. And you obviously, sometimes you lose stuff and there's some negotiation.
Well, I was hoping that one of those same real estate moguls would maybe do that with the United States debt was maybe one of the hopes that I had. So.
Well, that is probably the inevitable outcome of what we're doing here is that if you look at it's either hyperinflation, or one of the outcomes that's probably most probable is that they take all the debt and they throw it on a bonfire and they light it up. And they just say it's
huge,
a debt jubilee.
a huge bonfire.
Huge debt jubilee. And I actually wrote a paper I wrote a letter to the Fed back in 2008, which they promptly ignored for 3 months until I sent it to every politician I knew. And then they responded. But it was basically saying that, we need a debt jubilee. That would solve the problem. All the Fed has to do is buy up all the bad debt and then just light it on fire. Because no one owns it but the Fed, which means it's owned by the government. And yes, you're going to create a huge amount of inflation, but at the same time, it solves a lot of the debt problems.
And a lot of the public debt is actually owed to Social Security because Social Security, like the Social Security Trust Fund is literally it's in the office of the debt in West Virginia. And there's a filing cabinet that's not even like bigger than like the wall behind me, like very small filing cabinet, all things considered. And in that filing cabinet is just a whole bunch of IOUs that is literally the Social Security Trust Fund is a filing cabinet in West Virginia in the office of the debt that says, that the U.S. government ability to tax is what is funding this whole thing. It's just such a joke. I mean,
it reminds me of Dumb and Dumber, where they open the suitcase and it's full of IOUs. They said, "Oh no, this is as good as money. It's an IOU."
and actually, even George. Speaking of Dumb and Dumber, George W. Bush was actually in there, and he basically said the whole thing. He even sounded like us, but like, yeah, it's kind of crazy that this is that this whole entire system is basically just being run on this confidence of this. And speaking of running a company poorly, I was looking at Zero Hedge today, and we got Deutsche Bank. This is them speaking as investment managers, but they're saying there is no such thing as a free market anymore. So when you've got even Deutsche Bank coming out there and saying there's no such thing as a free market anymore, I mean, that's really the pot calling the kettle black. And John, I know, is going to get an extreme kick out of this, but yeah, if we go back to the article and it says at the extreme, central banks could become permanent command economy agents administering equity and credit prices, aggressively subduing financial shocks. It would be a bipolar world of financial repression with high real economic volatility, but very low financial volatility. A zombie
financial communism.
Actually, their exact words, John. A zombie market is their exact words.
Yeah.
And then it goes on to say the more central bankers control global asset prices, the more this could offset higher real economy volatility on exchange rates resulting from the exhaustion of policy space. Lastly, our conclusion is critically dependent on the assumption that we are stuck in a zero inflation world and that the central banks avoid targeting foreign exchange. If inflation or currency wars come back, exchange rate as well as broader FIC market volatility will almost certainly return with a vengeance. And so I know John's going to get a big kick out of that because Deutsche Bank is definitely, his favorite bank out of any of the banks that are out there. But when you've got Deutsche Bank saying the free market is dead, I mean, I think that is, the final.
Yeah. Among Deutsche Bank, it's probably the other really bad one is UniCredit.
Well, John isn't licensed where Kirk and I am, so John's allowed to kind of say some of this stuff, and we're
exactly.
not. So we don't endorse anything John says. I was just bringing up Deutsche Bank because they're in the news. I'm not saying that they're going to be, the Big Short Part 2 or anything.
No, believe
like
me,
I like sign language, John.
Yeah.
Sign language.
I used to be actually back in the day. I used to be regulated. But actually non-regulated because I was in the exempt market that we dealt with here, so we weren't regulated by the Securities and Exchange Commission.
Here's in Norway, or when you're okay.
No, this was actually in Canada. But anyways, I wanted to show you guys something interesting here. I think what is going to come next. Who's going to bail out these banks? I believe it's this is the Exchange Stabilization Fund, and of course, what does the Exchange Stabilization Fund? What is one of the things that it holds? Almost over 50% of their assets are actual, as you can see here, special drawing rights from the IMF. So that's where I believe they're going to try to pull this off, because SHTF, is going to happen. The bailout.
Well, we got all the toilet paper for it.
Yeah, well, actually, I think that toilet paper, after this is all over, our currency fail, toilet paper will probably be a pretty good currency for to get into something else. But that's a whole different story. But
Zim dollars, right?
Yeah, Zim dollars. No, it's interesting. I run a website that I just started up, which is called bankrun.org, because another thing that they're coming after now is, of course, the cash portion, because we were talking about, me and Chris were talking about, Kirk, we were talking about actually the importance of, financial advisors weren't allowed to, have their people being allocated into cash in the big firms. And of course, cash now we're seeing as a big run. Australia is really starting to see a strain on their banks with a tremendous amount of people over in Australia. I actually wrote a report back that was 2018 on Australia. I was warning about, the strain on the economy, the massive real estate bubble that they had. And also I was looking at their, insurance schemes that they had over there for their banks. And they had something called the Financial Claim Scheme. It's the FDIC in Australia. They were actually producing $20 billion to bail out, any failing banks. But the problem is, if you do it with a big bank, major bank in Australia doesn't have $20 billion. It has anywhere between 900 to 600 billion, the major banks, NAB and Commonwealth Bank and all these other banks. So they are actually, in a lot of trouble now, because cash is the only thing that, throughout history, cash is what have always, had banks go bust, because that was their Achilles heel. And that's what they're coming after now with the Federal Reserve, they actually in the Congress now, they tried to push in, a digital currency into it. And there's major moves right now by central banks around the world to kind of eliminate that cash portion of the banks, because that is the only place where they really have their Achilles heel. When you go and take physical cash out of the bank, that is always, because in banks, like I looked at their physical cash to the deposit ratios, it's minuscule. Most banks have less than 1% in physical cash that, protects whatever deposits that they have on their banks. So I had bankers, getting mad at me and saying that, John, listen, we could just sell, short-term debt and all this other stuff. But I said, what if you get to the point where that debt is not looked upon as a good investment anymore and you don't have any buyers? Well, I guess you can sell it to the Federal Reserve and they would print up notes physically. I don't know what they would do. But again, the whole thing with the current financial market and their real big Achilles heel right now, we're seeing here in Canada, actually in Winnipeg where I live, there's several credit unions and banks. There was a major bank, RBC, had 3 days to actually for you to recover, cash from them when you wanted to take cash out of the bank. There was other ones that have put up $5,000 as a limit, and other ones So you're starting to see some strain happening in banks where people are, trying to pull that cash out because they're worried. And especially if I was in Italy looking at UniCredit, for example, which have the worst rating of the derivatives market right now, like they have their credit default swap being at 238 basis points, which is the record highs that Deutsche Bank was back, in 2015 or 16 when they had their cocoa bonds.
I just love when Deutsche Bank is the one calling people out when it's like instead of like looking at what everybody else is doing, how about your economists just go look inwards? And so it sort of reminds me of, what is it, like King of the Hill, when that one crazy guy is always trying to look at every conspiracy but then doesn't realize that his wife's sleeping with like that one John Redcord down the sleep. He recognizes every conspiracy except for the one that's like right in front of his face. It's like, has anyone like ever at Deutsche Bank, and the other analysts ever been like, you know what? There's actually no way that we can actually, in my opinion, that they can, just cut themselves to prosperity. Oh, if we just slash, if we're losing, what is it? Oh, we lose money in every one, but we're going to make it up in volume. I mean, that's sort of like, I guess what Deutsche Bank's, MO is of, what's going on over there.
Well, the thing is, Tim, throughout history, whenever you start to create a banking system within a society, you always get people that are opportunists. Say, as soon as you can start creating money out of thin air, through commercial lending and so on, all these schemes that they've been able to come forth with, it's very easy to misuse that and then, get into, certain investments that, are just going to get flawed, or you just, like back in old days, just lending out, exorbitant amounts of money to people. And then you hit a peak in the housing market, for example, the old savings and loan banks. So you get problems there. There's been, like, ever since banks was created in Venice in year 500, there always have been different schemes. It might, of course, like lending money is not a bad thing. If you want to create economic activity, I think you need lending. But, what are you backing it by? Are you printing it out of thin air, or are you actually having that physical money up front and then taking the risk with your actual currency that you held in your hands that you have to borrow over to somebody else for a risk?
Yeah, I was gonna let Kirk take it on from there, but it looks like he is muted right now. And want to say what's up to everybody in the YouTube chat right now. Definitely appreciate the people who are out there supporting us. Let us know if you do have questions that are coming up. But I know pivoting back to Kirk, being one of the experts when it comes to what's going on with the CARES Act. What are some other things that you see going on in terms of this legislation and and probably, do you think this is only step one, that it's going to be I know Nancy Pelosi's already talking about another $1 trillion rescue, and then Donald Trump's like, wait a minute, we can't have $1 trillion rescue, we need a $2 trillion rescue. So now, I mean, come on, we elect Republicans to take control of everything, which I know they're not controlling everything now, but this is all the same. This is the whole reason why I wanted. I mean, I never got my hopes up. I mean, let's be real. I knew that they were, and it's funny because the other day I saw Donald Trump actually had a hat that he was selling. It said woke, and then in the description, the very top of the description, it said, and this is on Trump's official, and I'll go pull it up for the B-roll when you guys are talking, but it says high sellout risk. I'm like, oh, perfect, a Trump hat, and then at the very top it says high sellout risk. I'm like, perfect.
Sorry to interrupt, Kirk, but it was like Timothy Geithner and Hank Paulson when they just came up with a number. It's like, oh yeah, let's do this. That's basically what he said that he came up with.
Yeah, I don't.
Right.
I think it's going to be hard to put a number behind this. Quite honestly, I mean, you have all the research firms and all the financial institutions out there coming up with, well, GDP is going to be this and unemployment is going to be this. We have no idea what it's going to be. Part of the reason that the market is going up and down 10% in a day is because there's no insight into where this is going to end. This is going to end in a week, then the numbers are very different than it's going to end in 9 months. And honestly, I have, I could tell you the Boston point of view, and I think this is probably replicated in some other states, but, we're pretty much, our kids are out until May 4th. That's when they're allowed to go back right now. Now, I would guess probably another week they're going to push that back. They're going to keep pushing it back. At some point, they're going to say, well, probably till the end of the year, the end of the school year, which is pretty much June. Well, then we've already heard conversations about summer camps not being open in the summer, and 4th of July is being canceled. And these conversations are happening because people are really considering.
I guess you can call it band camp, but it's because it's banned. Okay.
Yeah, it happened at band camp.
So no. This time it was banned. So like BANNED.
BANNED.
So banned.
Yeah.
Yeah. So band
Nice.
camp. It's been banned. All right. Sorry about the bad dad joke.
It's like Trudeau. Trudeau just came out and said that we're gonna wait to open the economy until we have a vaccine. Like he's
gonna keep self-isolating from his wife for another 4 months. So.
That's probably what it is.
Which somehow she caught coronavirus from another guy, Egregious Eldris or something. So.
Well, his mom. Some people think that his mom, had some was having fun over in Cuba.
Well, we're getting off the rails.
Too much.
We'll take the tinfoil hats off for a minute. Yeah. Yeah, no, I think, so it's interesting. I don't, it's hard to really guess what's going to happen coming from here. And I think that's what Wall Street does, is in large part right now they're guessing. So anybody who comes up with any sort of proclamation of here's what's going to happen, they're full of it, because no one knows. And you can't make any sort of projections based on 1 week, first 9 months or 18 months. I mean, they're already talking about what happens if this is still going on in the fall. What happens if they let people out and then it restarts again? I mean, there's so much we don't know that we're just at a point where we just have to kind of like assume it's going to be like 6 months. That's my assumption, because if it comes back quicker, then we're all going to be in better shape for it. But, a lot of corporations, there's some financial shenanigans or financial engineering, as we call it, where they have a bad quarter once a year and they just throw everything, including a kitchen sink, at it, and they say, oh yeah, it's going to be terrible. And then the rest of the year, they kind of, massage the numbers a little bit.
Yeah, and the government does that too. I mean, I remember back in like 2014 or 2015, they just took all the bad crap, threw it into like the fourth quarter, I think, of 2014. And then I think I'm doing this off the top of my head, but then the next quarter, it was like that, like 5.2 or 5.3 GDP, which was actually better than what actually Trump has actually done, which when everyone was touting up what Trump was doing, I'm like, you do realize that Obama did have a couple one-off quarters. And so if you want to, say that this is the greatest economy ever based off of a 1 quarter GDP, because Trump didn't have 3% annualized. So he kept touting, oh, we're at 5% GDP. I'm like, well, actually Obama hit 5% twice. And everyone knows I don't like Obama, but I'm like, I just want to keep things consistent. And like, if that's the measuring stick you're going to use, then you got to keep it consistent. But even you look at how Obama did it, like, okay, it threw a bunch of stuff into 1 quarter, and then, we start bombing Libya. And now that you throw in a whole bunch of new bombs and war stuff, we throw that into Q1 GDP, and now we're at 5%. But I'd argue that spending money going bombing a bunch of places is not like positive GDP growth, because then we're going to have to go waste money to build those places back up if we ever get out of there to begin with. I know we're getting off the rails a little bit of
it's the broken window fallacy. I mean, they teach that in economics 101, and it doesn't work. I don't know why they ever thought that was a good idea, but yeah, let's go break a window and then we'll go replace the window, and that will add that to GDP. But
he's there, Paul Krugman. So.
Yeah, I'm not a huge fan of that theory. But if you kind of look at what's going on, I mean, Tim talks a lot about this in his show, but one of the things that we do is we focus on risk management first. And there's this idea of financial resilience that we really, really kind of put first, first most of all. And it's kind of a play off Nassim Taleb's Anti-Fragile, but it's looking at how can you be resilient? How can you be more resilient? And so we do risk management first, which is, we don't know when the market's going to do what it's doing now. And we talk about black swans, they're out there. No one can predict when they're going to happen. Even the people who predicted 2008, a lot of the people who really spot on at that, they were like 2 or 3 years early. Well, that's great, but that's 2 or 3 years of returns that you're missing out on. So, what really is important is focusing on managing risk. Because these things are going to happen. Everyone knew that the market was overvalued. Everyone was talking about it, yet they still invested because they knew that the market could keep going higher a lot longer than you can remain solvent. So don't try to time the market. You just try to manage risk. Now, the way we look at it right now is that I don't know where the market's going to go in the next 6, 12 months. I just know that there's a lot of risk out there, and I'm not taking on the kind of risk that's out there. I would rather take really low risk investments and really focus on that. So like mid-March, when the market just blew up in certain areas, like mortgage bonds, totally blew up, and we took advantage of that. Silver cratered, in like a few days, and we took advantage of that. Like, it's just about finding opportunities when they hit. You don't have to try to time the market, because, there's one thing that happens in recessions or depressions, And it's some people call this, it was like an older term and people don't use it much anymore. It was called like what's it called? Not the pendulum and the sandpaper, but it's the guillotine and the sandpaper. Yeah. So you have when the markets sell off like they did, they sell off big time. And then they have this sandpaper action, which is this back and forth volatility, 10% up, 10% down. The market retraces 50%. Now it's probably going to retest the lows. You have that kind of action. And what it does is the action forces the most amount of people to lose the most amount of money. And that's really what they're focused on. So, that's, if you kind of look at it from that perspective.
Are we talking about the Fed, that their action is what's going to cause most amount of people to lose most amount of money, or the government, or who are we talking about?
Not unless you're a big business or a bank, then you're in good shape. but basically it's about managing risk and about focusing on that risk management. And that's what so we don't have to know the future. We just know how to manage risk. And so then whatever the outcome is, we know we're comfortable with it. And that's really the secret of kind of what we do.
Yeah, no, and it has worked out, really well. I mean, do you kind of want to talk about maybe what you guys were doing, when you started your strategy, because I know when I really kind of joined, I mean, by the time I was able to kind of go up and running, we're talking really like August of 2018, and maybe, do you want to talk a little bit about what's and actually I do see the recording is off, so I've got it recorded somewhere else in another screen application. Cool. So we're good on that one, and it's also going out live too, so we do have people watching this live. But yeah, so do you want to talk about maybe a little bit about what you were doing going into all this? Because really it really started, if you take it back to 2018 when you had Jerome Powell saying we're on autopilot, going back to October 4th 2018, and we were in a strategy even leading up to that. So you want to talk about maybe what happened to the portfolio strategy going into that, and then coming out of that, and then getting back into because we went from a bad market in Q4 2018 to amazing year in 2019 to obviously what happened the first quarter of this year and what's still ongoing. Maybe you want to speak to a little bit about that.
Yeah, let me take a step back even further, because I think it'll help put this in context for what we do. So back when I started in the industry in December '99, everyone in the office, I was working at a wirehouse, and they were just saying, you were like Jim Cramer, buy. I'm like the
only person that maybe had like a worse starting date than you, being 1999. Mine was September 15th, 2018, which was the actual day Lehman Brothers went down. So I mean, I guess it depends on what. And then Luke and I and with John started to change the news channel. That Monday we first dropped 2,000 points. So it's like my timing and all this stuff has just been fantastic.
Perfect.
Along with you,
Tim's the contrary indicator.
Yeah, along with you. Yeah.
Yeah. So we did well during that time, given the fact I was brand new in the industry. But and when everybody was saying buy the dips, well, it kept dipping, and I was like, this doesn't make sense. Like, why are people keep saying this? This is really silly. And I have a background in economics, so I understand kind of like the way that the system's structured.
No, don't say that. I always anyone that has a background in economics, I always be like, I take them less seriously. So does Alexandria Ocasio-Cortez, and so does John and I. But we're one of the few that actually I think has like actual real opinions that matter in terms of economics. But sorry about that. No.
Wait, you're putting me in the same field as AOC? Come on.
Well, it's all economic. People that study economics, so.
But anyway, so going into 2008, in the summer of 2007, we went all to cash, because we just, we saw the writing on the wall. We didn't know when it was going to happen. We didn't know what was going to happen, but we knew it was going to be ugly. Everything I heard from my, friends and research I was doing, it was like, this is not going to end well. So we went to cash, and we missed that. But we also, the market could have gone up for another 3 or 4 years. So we really did a lot of work after that to figure out, all right, how can we manage the risk in a market that could continue to go higher when we can't actually predict the end date? So, what we did a few years ago is we recognized, we use a lot of risk management techniques. And a few years ago, we recognized that it was really cheap to manage risk. And, prior to that, we were actually making some good income from these strategies, but we were pretty much acting like an insurance company. Now, we don't use insurance products, but, conceptually, if you want to look at it, it's kind of like acting like an insurance company, right? So an insurance company, they insure your house, the property casualty, from like a storm. It probably won't happen. Maybe once every 100 years it'll come, and they'll have to pay out the claim. But until then, they get to hold on to your money and make money off you every year. Well, that's great if you're an insurance company. But if you're, right after the storm, insurance is really expensive. So you don't want to buy insurance right after the storm, because it's really expensive. It's like buying fire insurance when your house is on fire.
It's like buying toilet paper after a shitstorm. No, sorry.
Right. Yeah, I mean, if you're buying fire insurance while your house is on fire, it's going to be really expensive. But if you're buying fire insurance when you've never had a fire in your house, it's really cheap. So the way that we looked at a few years ago is, he said, all right, it's really cheap. Let's manage this portfolio differently. So we were effectively buying fire insurance on the portfolio. So in 2018-19, when the market went down 20% from peak to trough, the market dropped, and it could have kept going, and magically it got bailed out there at the end. Still curious as to who went in with all that buying right after Christmas, but I could probably take some guesses. But basically, what happened was the market sold off huge, and then it rebounded in a huge way. But if you look at, everybody looked at 2018, I think it was down 6.38% or something like that. 2019 looked like it was up 30 some odd percent, depending on which index, which S&P index you're looking at, but it's right around 30. And you look at that and say, wow, they had a banner year. But if you really know what the S&P did, from peak of 2018 till the peak of 2019, it was up like 8%. From Q3 of 18 to Q3 of 19, it was up like 1.7%. So the reason I say this is just to show that, like, 2019 wasn't a banner year. It was just coming off an extreme low. And if you look at, what we're doing here, some of these quarters might look great and some might look terrible. But at the end of the day, we have to pick a marker, and that's the way it's going to look. It's going to look like, hey, 2019 was great. It really wasn't. So if you managed your risk properly, you didn't make 30% in 2019 because you didn't lose all that money in 2018. So the way that we manage risk is right around the S&P, when won't mention the ETF, but it's trading around 330. It peaked out at 339, and we managed risk right around 330. So basically below that, it went down to like what did we hit the low at? It was like 200. Sorry, 220. Okay. It was right around 220 from 339. That's a huge drop. It was like 35%. And we didn't participate in that drop because we were out. We were out of the market at that point. And what was nice is we just had to sit in the sidelines, and we got to like strategically look at good investments at that time because we had cash. We had the ability to go in and buy stuff when it was cheap. And, like I mentioned earlier, we made some of these good investments in the mortgage market back at the low, and silver and a few other things that were sold off. And so we made some good investments then, and we're looking to cash out of those now, and we'll just sit in the sidelines and wait again, because most likely the markets are going to retest the lows. And if they don't, I don't care, because we still have exposure to the market if we need it. But we don't have the downside, and that's really the key. It's, most strategies out there. And I want to take a few minutes, if you don't mind, Tim, to really talk through this part of the strategy, because this is really important. This is what most people don't realize. This is kind of like an insider tip here. So if you look at 95% of investment managers, they manage money the same way. They come up with a different wrapper. They say, oh, well, we do this differently. We do this differently. But the wrapper is essentially, you're going to diversify your portfolio with a bunch of different funds or asset classes, and you're going to try to diversify, and you're going to reduce your risk. And of course, you're going to reduce your upside as well. That strategy is what 95% of the people use. And that's the way that their head is built, is around that. You look at Warren Buffett, you look at people who have like 10 positions, they don't do things that way. But most investors do. And they do it because they're trying to reduce their risk. And that's the way they were taught through Economics 101. That's what I was taught. To me, it never made any sense. So I look at this and I say, all right, look at 2008. Unless you were in cash or gold, you were effectively down 38.5%, give or take a few percentage points. Now, how's that possible, right? How's it possible that everything was down the same amount? Well, the reason is because the whole investment field is interconnected. And we did a lot of research in 2008 and came up with this. We recognized that, like, in good times, correlations work well. Your small cap, your large cap, your bonds, the correlations work well. But in times of stress, like right now, or 2008 or 2018 in December, like those times of stress, everything correlates. And the reason it correlates, and this is a lot of research we had to do to find this, the reason it correlates is because the institutions own it. So all the institutions operate the same way. So if you think about it, they're the ones that drive the market. Not you, me, John. Like, we don't drive the market. We're not big enough. The institutions manage billions and billions of dollars. So if they're going to sell like a stock, like an IBM or an Apple or a Microsoft, they're going to sell that, then the stock's going to go down because they're not selling 10 shares. They're selling 1 million shares. So the institutions drive the prices. So it used to be you can invest in Timberland. That had the closest to zero correlation of any asset I ever saw. It was like negative 0.01 in like 2001. That's what it was. Now the correlation's close to the S&P. Why? Well, because the institutions didn't own it, but now they do. So now it's correlated. So it doesn't really matter what you're investing in. In times of stress, it's all going to sell off in the same manner, in approximately the same degree. And that's the reality of the markets that we have. So diversification no longer works the way it was intended. And it was the way it's intended and the way it was actually constructed was proper. You invest in non-correlated assets, but now the correlation is driven by the institutions. So if you're in an asset class, Timberland, real estate, managed futures, you name it, all of these big asset classes that these big institutions are selling, they're correlated. It's too late.
And one of those big ones already went down. It was, it begins with A and has a other letter and there rhymes with Queen and then had R. One of those funds that was basically designed for when, what hit the fans and we're going to manage everything, saw a massive outflow. And it's funny because those guys were actually in my office in January of 2017. And they're like, listen, we've got all the best currencies. We've got all of this or that. I'm like, well, actually, you don't have the currency that performed the best last year. And the guy goes, what do you mean? I go, you don't have Bitcoin. And he honestly gave me the dirtiest look you could have imagined and then tried excoriating me like the rest of the time. And actually after that, about 2 months later, I pulled all the money out of that they were managing because it wasn't doing what it was supposed to be doing at the time. Now it seems like, 3 years and, about 2 months too late, everybody else then followed suit. But, they gave me such a dirty look. And like, meanwhile, the best thing you could have done and non-invest Savoy's past performance, indication of future returns, blah, blah, blah. But, when I told him that in January 2017, the best thing he could have done for his fund could have been to invest in the Bitcoin. Now, I know that wasn't their deal. I was just making, kind of a funny little side comment. But the guy got so pissed at me for saying that. And so so when I read that article about, their entire thing blowing up the other day, I'm like, oh, well, it couldn't happen to a nicer bunch of people over there who thought they were just a bunch of big shots in my office. But
yeah. So and I love that story. I think that story is not unique. I hate to say it, Tim, but those story happens over and over and over again. And you're spot on because that's the way Wall Street works. They just sell product and that's how that's how the street runs. I mean, people have to understand that. They're salespeople. Their job is to sell product. We're not. We're advisors. We're fiduciaries. Our job is to make your life better. We don't sell product. So when you look at the way that 95% of the people do it with the diversification and what they call MPT or modern portfolio theory, that works during normal times. And when times are not normal in crisis mode, it doesn't work. Well, when do you need it? You don't need it in normal times. You need it in crisis times. So we went back to the drawing board many years ago and we recognized all right, if we're going to actually manage money for high net worth people and do it really well, then we need to have a risk management strategy. Because if you really think about it, when you're rich, you don't need more money. Like, I know you want more money, but you don't need more money. So most of the ultra high net worth people I know, their job is to primarily focus on maintaining their wealth. They want their wealth to last generations, not just 10 years. They want it to last like 200 years. So if they're going to do it, their job is managing risk and not taking huge risks. So there are high net worth people that do take a risk, and that's great if you want to do it for fun. But if you want to be smart, you want to take at least a huge chunk of it and make it your safe money. So the way that we looked at it was, well, if we're going to manage risk properly, we're going to focus on how do we not lose money first. So we manage risk, and risk management comes down to identifying all of the risks that exist, mitigating as many of them as possible, and being comfortable with what's left over. So our strategy is more tactical in nature. So we're not always, at the bottom of the market. So mid March, we were not managing risk. We were looking at adding risk because the market the house had already burned down. If we're talking about fire insurance on your home, you don't buy fire insurance when the house is on fire. It's too late. So we were looking at, hey, now's the time to sell fire insurance because it's really expensive. So, hey, let's take some time. Let's sell some fire insurance on the same home for a really hefty premium. So that's the kind of thing that we're looking at, is inverting that in a time when it's really more profitable for the investor. So being more tactical allows you to move with market conditions and not being set in your ways. So MPT, so here's a big difference that people need to understand. If you're buying into MBT, and there's nothing wrong with it.
That's modern portfolio theory, for in case everyone that's out there.
Modern portfolio theory, MPT as we call it. MPT, the reason that people get it wrong with MPT, and there's nothing wrong with using it. I don't agree with it because of what I've just outlined is some of the problems. But there's nothing wrong with using it. The problem is people don't understand the instruction manual. The instruction manual is you buy and hold. That's it. You have to diversify and you have to buy and hold. So even though crisis mode is not going to protect you, if you buy and hold, historically speaking, the market should come back, and it should come back over time. Now, I don't agree with that strategy. But if you do agree with it, you need to hold on, and you can't time the market because nobody can predict the future. I don't care who you're talking to. They can't predict the future, even though they all try to. And they say, oh, here's what's going to happen tomorrow. Well, no one knows that. So the strategy we use is not trying to time the future, because that's stupid, right? You can't try to, you're just guessing. So what we do is we manage the risk. And if we manage the risk properly, the future takes care of itself. Because if you look back at the math, right? Everyone tries to beat the index. Oh, the index was up 20. Well, I made 21. I'm a hero. Well, you're an idiot, because if you look at the way that works, you're guessing. You got lucky. It's like going to the casino and say, hey, I got lucky. I won some money. Well, yeah, you did get lucky. It's not skill. There's no skill. I mean, there is skill somewhat, but generally speaking, it's the luck more than anything else. Because some days you're going to go away have lost money, right? It's just the way that the numbers work. So we like numbers. So we looked at the numbers, and we recognize that you don't need to beat the index to outperform it over time. You just don't lose when the market takes a big swan dive. If you don't lose half your stuff, then you don't need to make that return to beat the index. So here's another math example. If you lose 50% of your money, what kind of return do you need to get back to where you started? Most people think it's 50%. It's not. It's 100%, right? If you have $100 and you lose half of it, you have 50. You need to make 100%, $50 to get back to 100. That's a lot. I don't know about you, but making 100% is quite a big
And
number.
if you're actively withdrawing money, then it just compounds that even
and the
even
stock
worse.
market. Yeah, people are talking about the stock market being up now. Nice rally, but it's nowhere near what it lost.
Yeah. So if you think about it, and that's a good point, John. I was just going to get to that. So the market went down 35%, right? So that brings it from 100 down to like whatever that is, 65. What kind of return do you need to get back to where you started?
And how many people crap their pants and then sold out at the bottom? Because the only way things go down is if people are selling. So which means a lot of people sold out. A lot of the retailers sold out. They didn't sell like the big CEOs who exited their companies in January.
We also do have retirees, baby boomers needing to sell assets too. So that's another problem.
Because everybody's living paycheck to paycheck, and now they're not even living paycheck to paycheck because they're waiting on the government's $1,200. And so everyone, including corporations and individuals, don't have the money to just ride this thing out. But the government made it so now you don't have to take money out till you're 72 years old. But meanwhile, there's other things in the back end that they did that that now you can only have inherited IRAs in retirement accounts go on for 10 years as opposed to being able to stretched out hypothetically forever. There's a little asterisk next to that statement. But yeah, it's absolutely ridiculous.
So Tim, you're probably one of the best advanced financial planners I know, like doing a lot of advanced strategies. And this CARES Act is a godsend for you. I mean, there's so many advanced planning things that you can pull out of this. We've been playing around with this for the last week since it's only been out.
And I've been too busy because everybody's been wanting to buy fire insurance on the house that's already burned down. When I'm like, I was trying to tell you guys for the past 2 years, screaming at you. And then we even have clients, or prospects rather, who we were telling them what they should do, coming on board, what we're going to do for them, not necessarily what they should, what we're going to do for them. And then we did it. And then we're still waiting for them to come on board. I'm like, we just told you like what to do, the game plan. And so do you think your current advisor who didn't see this coming, who lets you get into the car wreck and was like, oh, don't worry, we got a really good, seatbelt over here. So as you get thrown from the car and, end up with brain damage, oh, don't worry, we're going to get you back to the promised land. No, they're not. If you didn't know what to do to, avoid this from happening, and to Kirk's greater point over here, if you, avoid if you get like what we did last year, we got most of the gains going up, and then we don't get, we hardly lose any money at all this year, especially relative to everybody else, doing amazing. If things keep going down in the market, and then all of a sudden we're down 50% and we step in and are fully invested again at that point, we have twice as much stuff. So then twice as many stocks. So then that way, when things, in my opinion, inevitably go up on a long enough time horizon, and the key point here is on your time horizon. So I was always really trying to work on that sequence of return risk. Now, I don't think it's active anymore, but I actually own sequenceofreturnrisk.com. I don't think it's active, but one of the key points is when we talk about if you go down to 50, a lot of Americans think you need to go back up 50 to get back to even, and that's even before they had Common Core math. But now the fact that if you're actually withdrawing funds and you're down 20%, I think the math is, I don't have it in front of me, but I think it's you got to go up 42% over the next 3 years to get back to even. And so a lot of people who've already been scared, what list, they've already sold out. I had people who were out of the market from 2008 after everything till right when Trump got elected. And now it's like, oh, Trump's got elected, new day for America. And now they jumped in. I'm like, wait a minute, you guys have been on the sidelines for 8 years, and now you want to jump back in? And we see how quickly, boom, 3 years of gains wiped out. And in many markets, 5 years of gains have been wiped out. And I don't want to list off anything, but if you go to even Morningstar and just check out their small cap indexes, mid cap indexes, large cap indexes, international without America indexes, aside from the S&P 500, all of them are negative on a 5-year trailing basis. Like Russell 2000, all of these are negative over 5 years. And so, when we tout how great things are doing in America, it's really only been going great for the big multinational conglomerates. And so the everyday mom and pop shops were already decimated before this and didn't see a lot of that bounce. And now, okay, great. Here's your $1,000 per employee check that's going to get you after you've already been out of business for 2 months. And then, of course, the government then has stipulations of, if you're an airline, you've got to keep flying X amount of routes. So then you got to keep losing more and more money just to get these incentives, but yet there's perverse incentives where the incentives can help make the companies go broke. And by the way, if you do take any ballot money, you can't fire anybody. Well, maybe these companies need to fire some people, and maybe not firing them will make sure more people end up going broke or more people end up losing their jobs. And so, it's always, the law of unintended consequences. Let's make everybody feel good. Let's never go through any hard decisions. And by the way, if we have Republicans running everything, then we're still gonna basically do what the Democrats would have done anyways. And so it's just the same old. And I'm ranting over here, doing the same old type of rants. But sorry, I'll let you keep going on, Kirk.
Yeah, another point here. So, and you kind of alluded to this. There are a lot of people who are perpetually bearish. They've been bearish for the last 20 years. They've missed the last 2 bull markets, and they were right once. And every time it goes down, they come out of the woodwork and they're like, "I predicted this 10 years ago." And even though the market was up 400% since then, I was predicting it the whole time. You got to be careful of people who are perpetual. Let's just say their opinion never changes. No matter what's going on, their opinion never changes, whether it's their perma bulls or perma bears. And the perma bears, the interesting thing about the perma bears is their argument is always the most intellectually sound. It's always it's like what John was saying earlier about debt is going to overwhelm us and we're going to become Japan. Well, I would agree with that. The problem is even though that's the most intellectually sound argument, it doesn't mean that the Fed's not going to come in and print tons of money and just blow that philosophy out of the window, right? Because you just don't know. You know that they're not going to let that happen. So the point I'm trying to make is that when you talk to somebody who is very set in their ways, MPT, as we were just talking about, is very much a philosophy. You have to be set in your ways. It's just part of the instruction manual that you get when you buy into that. And we're more tactical. So the way I look at it is, if I'm driving down the road and there's a boulder in the middle of the road, what do? Do you hit it and just say, I couldn't do anything about it? It was sitting there. I just hit it, get thrown from my car, and then, get up and then get back in the car and keep driving? Or do you decide to just drive around the boulder? I mean, if you're MPT, you're basically hitting the boulder and you're knowingly hitting it because that's part of the strategy. Whereas I look at it and say, I'd rather just not hit the boulder. Why not just drive around it? Why not lose 30 to 50% of your money? And you'd be better off for it. And if you look at the returns over the history of the S&P, if you just didn't lose big time, to use a Trump phrase, big time when the market's huge, yeah,
the most beautiful, perfect losses America's ever seen, huge.
If you don't get huge losses and you don't lose half your stuff or more, then you don't need to outperform, because you will outperform over time if you don't make those huge losses. And that's one of the keys, is you just need to find a strategy that makes sense, that's about managing risk. So what the big problem is, most of, as John was alluding to, our demographics are in such a way that we're in real trouble. There are a lot of older people, they're retiring, the baby boomers are retiring, they're taking their money out. And, that's going to cause problems in the market anyway, because they're pulling money out. But, on top of that, they also need their money in retirement. Well, if you lose half your stuff, you don't have 10, 20 years to make it back. When they were younger, they could afford to go through a recession for a few years. But now, there are a lot of people out there who lost a lot of money in the last, month, and they're retired. I mean, I've talked to a lot of these people, we're getting bombarded with calls from people who want to work with us. And these people are like, what can I do? I'm like, well, you've already lost 35% of your money. I can help you. We can do triage, but the problem was you needed to do this before. So, we have strategies that we're using now to actually take care of the now problem, because there are a lot of people who've lost money already, and we need to do some triage. So we do have some strategies that's actually able to solve that. But, the reality is the time to plan is before the crisis, not in the crisis. So, you need to have somebody who's more tactically minded, somebody who is opportunistic and looking for the opportunities, and they're not just sitting on their hands and saying, well, I don't know what to do. Somebody who's actually out there and assessing the risks. I mean, we have guys like Tim and John on here who are extreme wealths of knowledge, in economics and the markets. And it's just surrounding yourself with really bright people that understand risk management, that understand the markets, that understand how things work, and not just sitting there hoping to get paid as the markets go up in value. Because hope is not a strategy. And anybody who is looking for that is going to get themselves into trouble. And quite frankly, it's not your fault if you're one of those people, because the whole industry has educated people that this is the only way to do it. They've educated people that if you're not buy and hold, then you're a moron. And if you're not buy and hold, then you're missing the boat. And this, my favorite chart that I remember seeing when I first started in this business, if you lose out on the top 15 days and the best performing in the market, then you're going to have a negative annual performance. Well, what they don't say is, what if you lost out on the worst 15 days in the market? What would your performance have been then? And I think that's the problem, is it's always one-sided. The perspective is always on the bullish side. And if they just said, hey, if I didn't lose out on the 15 worst days, I would have had a better return than if I had not missed out on the 15 best days. So I think there's a perspective here that's lost, because there's only one mouthpiece in the industry, and it's, one collective mouthpiece, and it's saying all the same thing. So I think that's really kind of some lessons that people can take away from this. I mean, it's Easter. I hope people are enjoying time with their family. I know we're all stuck in our homes. So there's probably way too much time with our family at the moment. But, I think as long as everybody's just sitting around and trying to come up with strategies for the market, this is one that people should really understand.
Yeah, no, thank you for that. We do have questions out there from the audience, so we're gonna, let Kirk get back to his family, or maybe they're sick of him too. But we've been talking about modern portfolio theory. What percentage of advisors or people who are working with someone managing their money, adhere to the modern portfolio theory? I mean, you think it's 90%, 95%? I mean, what?
99 probably. The people who are in the 5% are typically institutional managers like hedge funds, people like that, people like Warren Buffett. There are other strategies that aren't like that. Financial advisors, at least 99%. Because the problem is they're all drinking from the same trough or eating from the same trough. It's just the way it is. If you're at a big firm, they have an economist. They're all telling you the same thing. They're all drinking from the same Kool-Aid. And like I said, it's not their fault. This actually worked in the 80s and 90s. This was a viable strategy back then because the markets weren't as correlated as they are now. So if you were in the 70s, 80s, 90s, and you were doing this strategy, it was probably the best strategy. I have not back tested these other ones because there were certain instruments that didn't exist back then, so it wouldn't have been feasible to back test. But MPT, in my opinion, that was the time to use it. Because if you were buy and hold, it went through bumps in the road, but the market kept going up and the institutions were not driving the market. That's a huge part of this. The institutions are what drive the market.
And we didn't have ETFs. We didn't have ETFs and stuff weren't really that prevalent. Even in 2008, the ETFs were barely even prevalent. Even in 2008, it's absolutely exploded since then. And I was working for a mutual fund company, and like even telling the guys, like, you know, like, kind of the writing is on the wall, and they literally took everything I said and then basically laughed at everything, like, oh, this is how we've been doing it since 1925, so I think we knew better than you. And then now my entire office got shut down before I left. And then like the manager who was telling me I was on a rocket ship about to take off and I was an idiot for leaving, he lost his job, everybody else lost their jobs. So I'm like, was that rocket ship with the Columbia or something, you know, because it actually ended up exploding. But no, he was a nice guy. But anyways, in another question we have going on here, I think Kirk already sort of answered this, but he said, how is there even low risk in the stock market workout? The stock market made an 8 standard deviation move, and I think what they're referring to is you had an 8 standard deviation move. Hopefully they know that because I was talking about it, but in Zero Hedge was talking about if you had a balanced portfolio, I think over an 8-day time period, it went down 15%, which in terms of standard deviations, that was an 8 standard deviation event, which Wikipedia only goes up to 7 standard deviations, which is a once in a billion year event. And so I think, basically the strategy that we were using and you helped spearhead over an innovative advisory group, that was something that helped, insulate us against that. But maybe do you want to talk like a high level, maybe about that question about, when everything goes down? I mean, you sort of already answered that one.
Well, see, the thing is you need, and this is where the agility comes in. You need to have an agile mindset to know that times are changing. And, we change our strategy based on what the market's doing. So we had a strategy in 2018, and we decided when the market started, creating a lot of volatility, we trimmed it down a lot and we made it much simpler. Because what happens is in times of crisis, that volatility spikes, everything correlates, and then you don't have an opportunity to make the opportunistic chances that you would if you had a more simpler strategy. So in the last year and a half, we've had a much simpler strategy, and it's made it a lot easier for us to manage. But if you look at a strategy back in last month, and I can't believe it's April, it's like mid-April now. But if you look back a month ago when the market actually was a month ago on the 12th.
Feels like it's been like 3 years since the last time we interviewed you, and it was
it wasn't that long ago. But yeah, it's been a month since the drop, since I think the low point in the market. And if you look at that, we went into this, we were hedged, so we had a maximum loss. I think at the time it was somewhere around 3.5%. I think was the most that we could lose based on the numbers and when we had it. Now that changes based on market conditions. So if we tried to do that now, it'd be really expensive. But back then, I think it was right around 3.5%. And so that we knew that was the most we could lose. No matter what happened, if the market crashed overnight and went to zero overnight, 3.5% would have been the most you lost. And so we knew that going in, and that was the strategy. So if you think about it.
And compare to what you were doing compared to a 60-40 portfolio, both from the, a price appreciation standpoint and from the price depreciation standpoint, that essentially we were in the holy grail position of saying, listen, the market could easily lose 50%. It could easily go up 50% from here. We don't know which way, it's going to break or when it's going to break. But, I would say that our position actually, especially compared to your average 60-40% portfolio, that we were actually getting way more upside potential and taking a lot less downside potential. But yeah, it was not a super difficult strategy to run, yet almost nobody was running it.
Well, see, this is the interesting thing. So this is what happens when everybody drinks the same Kool-Aid, is nobody's able to think outside the box. So as an example of this is MPT is what people do is they characterize risk based on MPT, and they say, oh, well, I'm more aggressive, so I can have like 70, 80, or 90% equities. I have like, the remainder in bonds. That would be a typical MPT aggressive portfolio. And if you're more, moderate, maybe it's a 60-40 or 50-50. And if you're conservative, maybe it's the inverse. It's like a 40-60, depending on what age you are and the risk. And that's just the way people characterize it. The problem is that it doesn't account for a lot of things. And the reason this worked in the 70s, 80s, 90s is because interest rates were normal. Interest rates are zero. How are you going to have bonds? So part of the reason that MPT worked is because bonds are there to offset the stocks. So the correlation was, historically, stocks go down, bonds go up in price. So it offsets it. And not only do you have, let's say in a 60-40, you've got 60% stocks, 40% in bonds. Not only is it only like close to half invested, but also that 40% is going to go up. So then it offsets that. So that's why MPT worked. But now when you have bonds at 0% or close to it, let's say the market drops from now and your bonds are already at zero. Where do you go from here? The bonds are not there to offset the stock drop. So you have a much bigger impact in your drop of the stocks. So one of the things that we've done, and we've spent a lot of time with this, and people who are really, looking at managing risk, they're still stuck in this MPT mindset. And that's the problem, because they're looking at it with that lens and they're not stopping to get out of the box and look at it from a just reset. They're testing their assumptions, right? You always have to test your assumptions, because the second that you assume something, you're probably going to be wrong. Here's one assumption: real estate always goes up. How did that work out? Right? So, you have to look at things from like an outside lens and try to find a way to manage risk in a way that's actually practical. So we knew going in, no matter what happened, this is the most we could say to the penny, the most you would actually lose, if you went with that strategy. So if you think about 60-40, if I'm comparing a 60-40, maybe the max drawdown historically was like 25%. Let's just say, for sake of argument, I don't have the numbers in front of me, and maybe like a 50-50 would be like 15%. But the way that people look at risk management in the industry is they look at the 60-40, the 50-50, the 70-30, and they say, oh, well, with this strategy, the most you would lose is X. Well, why are you accepting that? How can you accept, I have a conservative portfolio and I can lose like 15 to 20% of my money? That's not okay.
In 8 days.
In 8 days. How can you accept that and say that's okay? So I never liked that. I never liked it in 2000. I never liked it in 2008. And we're always looking for ways to manage money better and to manage risk better. So we came up with this strategy and said, you know what? You could be 100% in equities with this strategy and have an extremely conservative portfolio, because a conservative portfolio in MPT standards means you're losing like 12 or 15%. But with us, it was 3.5. So which is better? A conservative MPT portfolio that's going to lose you, and I'm just throwing out numbers, and these are examples, and I don't want to get in trouble with the regulators, but these are close proximities. So if you look at that and say, why would I use this? Why not use the other thing? You have to look at it and say, what makes sense to me? Now, you might say, I don't care about the risk of loss. I want to take the most risk possible. That's okay. But you need to understand the risk you're taking. And the problem with most investors and most advisors, I will say, the majority of advisors, they don't understand the risk they're taking, because they're not money managers. They're not risk managers. That's not their job. Their job is to be a salesperson. I mean, that's their job. Tim and I used to work for these firms. They hire salespeople. They don't hire people who are good analysts.
Kirk has never Kirk has never asked me once, how much more money are you going to bring in today, or what phone calls you're making today, and that was, that's all they cared about. Every other firm I was at, it was, except for the last one I ran, the last one I was at along with Chris, not Kirk, but. So my first place was always, how many phone calls you're making? What do you do? It's always, and then I'd ask about, investments. It's like, well, the investments don't matter. We'll just, just throw them in anything. Like, that's sort of like basically the mindset of these guys is, it doesn't matter. We're trained to sell, and I don't care. And he's like, Tim, why are you out there? I got literally my first boss said, why'd you get an 89 on the Series 7? Like, it means you studied way too hard. All you needed was a 70. Like, you spent way too much time screwing around studying. And why are you going to get your CFP? You're going to be the smartest broke guy over there, trying to help out your clients, but that doesn't matter if you don't have any clients. Go out there and here's the phone book, and so that's, and I'm not really embellishing too much from how it actually works. And I had it way better than if you were at a wirehouse, or if you're at like another place based out of St. Louis that knocks on doors. And another question people have is they're saying, eventually will we see a pickup in the velocity of money, and will that lead to a hyperinflation? And maybe this can go along with another question too, because we got 3 here left. Another question was, why isn't gold moving up as much as we expected? And the last question was, does the Fed buying everything help the Fed in the long run? So maybe like all 3 of those can kind of be worked into one with, velocity of money, hyperinflation, why isn't gold moving? And then, does the Fed buying up all these assets, is that helping the Fed? I don't know. And I think maybe John can take the last one. Kirk, if you want to take the first 2. stab
So,
at that.
so actually, I'm going to take the first one and I'll pass it to John. The answer is no. John can elaborate. I mean, the velocity of money, I don't see that picking up anytime soon.
And the more money they're pumping into this zombie economy system, like it's almost then is going to guarantee that you're having a decrease in the velocity of money, especially when now the big banks are like, oh, by the way, we're not going to lend any money out unless we're getting a government guarantee on this mortgage or on this whatever business loan. And so now you've got the big banks sort of holding the Fed and the economy hostage and being like, hey, what, if you want us to lend money, guarantee it and backstop it all. It's sort of this this crazy system that we're going into. But yeah, do you want to take a stab at that, John?
Well, they're trying to shove money into the economy now through like UBI, kind of the $1,200, but that's not going to do anything really to the economy. Now, of course, everybody wants to have a piece of that $1,200. I see a lot of firms out there is like, these are the stocks to buy with your $1,200 checks, and yeah, and they're just really trying to get a piece of that pie of the little bit of inflation, which is extremely minuscule to the monetary supply in itself, and that is not going to hit anywhere in the economy. People are mostly probably going to hoard it because they're extremely insecure about what's happening next to the economy. So you're going to see that just keeping drastically going down. I don't know where like how far down it's going to go, the monetary velocity. But it's at record lows right now, and I don't see anywhere where it's going to go any higher because most of the money is getting created high up in M2 and M3, which is mostly in the banking system that they're not going to push around and push into the real economy. So you're just going to see the money sitting stagnant, and excessive reserves have exploded right at the Federal Reserve. So all that money is going to get stuck over there. Meanwhile, people are going to be more and more desperate. They might, try to have some modern monetary theory, BS, trying to push that out because they're really desperate about getting inflation going. But, at one point, if you push enough money into the economy, all that is going to jump into the economy, then that money is not going to be enough to, then stimulate because prices, as all this excess money is coming into I'm talking about the real economy now, not assets as stocks or anything, but when that comes in for people to buy things, that is just gonna raise prices, and it's gonna basically make the money that they got not worth that much when all is said and done. But when it comes to gold, for example, we're looking at gold. It's only in the United States where gold is not at record highs. All around the world, Canada, Australia, Norway, everywhere I looked, I think every single country except for I think not even the Eurozone. Actually, it's right at or around record highs right now because the US dollar is very strong. On top of that, of course, we talked about the paper ETFs that we're basing our real value of gold on. If you go actually and try to buy physical metal, I actually talked to some dealers now. You're looking at a lot of times you're looking at premiums up to 40 to 60% to buy physical bullion. Like we're talking about the real thing, not the paper ETF that the US dollar based price is priced upon. So you're actually seeing, they're actually the real, who was it? It was Mike Maloney. I was just listening to him. The actual real gold to silver ratio is not in the hundreds anymore. If you look at the actual physical price that you have to get, if you even get it, it would be more around 75 right now. So actually it's past the peak. It's going down, and we're probably going to see just more down pressure on.
And I think we'll have to tease that for next time because having that discussion when it comes to physical gold versus real gold, that's something that we could probably go on for a while about. But we're definitely appreciative of Kirk's time today. He is one of the founders of Innovative Advisory Group, which is not one of the firms, it's the firm that I work for. And so when you guys, I don't really bring him up that much, but when one of the ways that I'm able to do what I'm doing over here is now Kirk actually is now managing a lot more of my client assets. So then that way, I'm out here able to do videos with John and doing research, and people are like, oh, how are you able to do these videos and still manage my accounts? I'm like, we pretty much had the best, probably the best performance in the country over the last 2 years. So if you think, how am I able to do my job? I'd say, okay, do you want to go with one of the other guys who aren't putting out videos and just lost you 40%? So, Kirk's one of the ways we're able to scale things up. It's a great resource to have him here. And, thank you to Mickey in the chat saying, thank you guys. Great stream. I learned a lot. So Kirk, you want to give a quick plug for, your firm or our firm, and then, where people can find you. And then, thank you so much for joining us on this Easter. And thank you to your wife too. So thank you for letting me.
Thank you both for having me on. And I want to leave a teaser for next time too, is if you look at gold's been doing well, and you look at silver, it is not. Ask yourself a question, why is that? That'll be a teaser for next time, because I think it's a good content to talk about.
Such a tease. Okay.
It is. I am a tease.
I mean, we start with Jim Cramer coming, and then we're ending with this. So it's just so much here to tease. But where can people find you, with the LinkedIn or website? Give us the goodies.
Yeah, we're just giving you the climax here, Tim. So,
okay.
So basically, and one final thing I wanted to make on your point before is you made the distinction between, brokers and advisors, and our job is really to make your life better. The investment part is just part of what we do, but it's really all the other stuff that's important in your life as well. So people can find me at innovativewealth.com. That's our company where Tim and I work together. And innovativewealth.com, we have a lot of resources online for people who want to learn more about us and about certain topics. I also do the Money Tree Investing podcast, which Tim is a frequent guest on as well, where we talk about anything personal finance and investing related. And obviously, you can always find me on the social media channels. But yeah, that's the easiest way to find me.
Okay, cool. And I do want to point on screen, we do have your website up there right now. Also want to point out on screen, if you guys go to the channel that you're on right now, Tim Picciott with the Liberty Advisor channel, scroll down a tiny bit, you'll see featured videos. And then on that featured video, the third one in is the interview that Kirk and I had together, which, seems like it was 3 years ago. It was only really, I don't even know when it was. It was a month ago.
3 weeks ago.
Yeah, 3 weeks ago. I would highly recommend you guys check it out. But anyways, thank you to John Snyson. Actually, it's Tim and John, so I don't need to thank him because he has to be here. And I'll be talking to both of you guys later on. But anyways, thank you so much for joining us on this Easter, and we're going to end the stream. Thank you for everyone that was watching the live stream. Make sure to hit that bell so that way you guys see us during future live streams. Hope you guys have a great Easter, and we're going to stop this recording right now. So thank you.